Welcome to Sprott Media. I'm Albert Liu. U.S. stocks rose for the third straight day, even as jobless claims surge. According to the Labor Department, weekly initial unemployment insurance claims spiked above 3 million for the week ending March 21st, eclipsing the all-time high of 695,000 set in October 1982. Joining me again is Rick Rule, President and CEO of Sprott U.S. Holdings. Rick, thanks for joining me today. How are you doing on this Thursday morning?
Doing as well as could be expected, Albert, but thank you for arranging this and having me on. I've enjoyed this series of sessions. We certainly live in interesting times.
We do, and there's a lot going on with the threat of bankruptcies, which is the topic I wanted to discuss today with you. Because of your specific experience in the area, and I'm not talking about personal experience, but could you just sort of explain to the viewers what your experience has been throughout your career in dealing with business failure, restructuring, and bankruptcies and so forth?
In the decade of the 1970s, which was a decade where, of course, the natural resource businesses had the wind in their sails, I was active in several extractive industries, but importantly in the oil and gas business. And at the end of that decade, markets worked, of course. And as the oil price collapsed, many of the oil companies who had found debt to be the cheapest source of capital came into a circumstance where they couldn't repay their debts, and bankruptcies ensued. I didn't have to file personal bankruptcy, although probably I would have been wiser to do it. I elected to work my way through it, something I'm proud of today. But the consequence of that, and the consequence of being a secured creditor to several other companies that became bankrupt, gave me a career for a while in oil and gas insolvency. And I was involved as a practitioner in assisting companies and assisting creditors in the process of reorganizing bankrupt estates throughout the U.S. South and Southwest in the oil and gas business, and came to understand the process of the credit stack and bankruptcy quite well. I've employed the knowledge that I learned in those times, in the period 1982, I guess, to 1985, in my own lending business ever since. There's nothing like being a crisis practitioner that teaches you how to avoid crisis. So I would say that, my experience with regards to insolvency in extractive industries is very, very firsthand.
Rick, one of the reasons I want to talk about this is because I think the process is misunderstood. And we're in a situation now where the bailout spigots are wide open. There's a $2 trillion bailout being discussed right now. Estimates I've seen for what's going to happen with the Federal Reserve is the balance sheet is going to blow up to 9 trillion or more, and we're not even finished yet. So the models, I don't think, are accurate. And one of the arguments that proponents of bailouts use for the bailouts is that the United States, for example, needs an aviation industry, or we need, communications infrastructure, whatever it is, whatever segment is in trouble. There's an implicit assumption that those activities will cease and disappear forever if we don't bail out the companies. And so could you talk a little bit about what actually happens in bankruptcies and the difference between, a liquidation bankruptcy and a restructuring bankruptcy where the company continues to operate?
Well, you've given me a broad mandate to talk, Albert. It's important to note that particularly in bankruptcies involving businesses that operate physical assets, that a bankruptcy doesn't make the assets go away. It makes them change hands. It's a messy circumstance, and it's painful for shareholders, painful for creditors, painful for employees, but it's also a natural process. One of the things I learned in watching oil and gas bankruptcies is, first of all, the headline fact. When an oil and gas company goes bankrupt, the wells don't go away, the pipelines don't go away, the reserves don't go away. They change hands. The people who lost them, of course, feel bad about this. And the people who are inconvenienced, the creditors who get less than 100 cents on the dollar, the employees who become unemployed or underemployed for some period of time, there are losers, to be sure, but it doesn't diminish the capacity of the asset over time to produce oil and gas. Similarly, were an airline to go bankrupt, it wouldn't cause the pilots to lose their flying skills, nor the flight attendants their service skills, nor would it diminish the landing and takeoff slots available in publicly funded airports, nor in fact would it cause the planes to vaporize. What would happen was that imprudent lenders who had lent too much money on a plane would lose some money. And the shareholders who owned the airline would lose some or all of their investments. And employees who had counted on continuous employment would, like today, find themselves underemployed. And similarly, flyers might find themselves inconvenienced for some period of time. But it's important to note that insolvency doesn't eliminate either physical assets or intellectual property. It's just a process by which a capital stack, that is the debt and equity, which is insufficient to provide for ongoing concern status of the enterprise, gets restructured, reorganized, and re-owned by different parties. What I found personally, and I don't have statistics to back this up, but what I found personally in the oil and gas business is that invariably ownership of the assets went to stronger hands, which is to say that managements which had been imprudent in how they borrowed, or managements that were inefficient in production or incompetent in exploration, ended up being, if you will, thanked and excused. They lost control of the assets, and the assets went to better capitalized and more efficient competitors. Importantly, too, in bankruptcy, very often the circumstance is that larger competitors acquire small competitors. And while this goes contrary to the sort of yeoman myth of American capitalism, that is to say, family business, certainly in the public sphere, larger companies often have lower general and administrative expense relative to assets under management and relative to revenues, which is to say that often in bankruptcy, consolidation occurs. And consolidation is usually much more efficient as a consequence of a smaller management team managing a larger pool of assets. So although bankruptcy is messy, I would describe it as a normal and necessary way of dealing with market failure or policy failure.
Rick, when you talk about bankruptcies, it seems like that would be a normal sort of statistical occurrence in business. Sometimes you see clusters of failures. And I remember at one point you pointed to the fact that years ago, the market, and we talk about the natural resource market, they encouraged companies to be marginal. And so the industry complied. Here we see that perhaps the government, through its frequent bailouts, has encouraged companies to become marginal through stock buybacks and whatnot, and they've complied. So that's sort of one category. But then when you talk about risky activities or difficult activities like exploration, you would naturally expect that a lot of people would fail in that endeavor, and that's actually expected, natural, and there's really nothing you can do about it. So let's talk about bankruptcies when it comes, or failures as applied to very difficult and risky tasks.
Well, you've made two excellent points, Albert. I'll do my best to recite them. The first is that in extraordinarily risky businesses, high risk, high reward businesses like research and development or like exploration, too much capital makes the business inefficient. It encourages too many incompetent competitors. The bankruptcies don't happen, ironically, quickly enough. You'll recall our discussions in these interviews over the years, Albert. I would argue as an example that the mineral exploration business, the junior mineral exploration business, is almost hopelessly over-capitalized, not under-capitalized. Of the 1,500 to 2,000 junior explorers that exist worldwide, I would suggest that there's probably room in the market in terms of scale and management skills for 200 of them. And the other 1,000 or so, or 1,500 or so of them exist really as a consequence of surplus capital in the market. The industry, ironically, would be healthier and would generate better returns for investors if 1,000 or 1,200 of the listings went to listing heaven, so that the general and administrative expense associated with those zombie companies was left in investor hands to redistribute back to more efficient explorers. Similarly, the topic of marginality. It's ironic that in a period of low capital costs, low interest rates, and rising commodity prices, that the least efficient producer is rewarded best by the market. It's easy to understand by way of illustration. If the gold price is, let's say, $1,000 an ounce, and an efficient company produces gold for $500 an ounce, and an inefficient company produces gold for $900 an ounce, if the gold price goes from $1,000 an ounce to $1,100 an ounce, the inefficient producers' margins double, while the efficient producers' margins go up by 20%. In a circumstance then where capital is freely available and companies feel that they can run the risk of being marginal, that is, having high operating costs, the marginal producer ironically benefits from rising commodity prices, provided the availability of cheap capital, more than the efficient producer. In other words, the market rewards marginality. We have certainly seen that in the gold business in the decade that preceded, well, in the decade between 2000 and 2010. The gold price, if my memory serves me well, over 11 years, went from $250 an ounce to $1,900 an ounce. An astonishing performance. At the same time, free cash flow per share in the gold mining industry declined. It took real skill to wreck a bull market like that, and you can lay it all on marginality. Now, the truth is that if markets are allowed to work, which increasingly, of course, because of government interference, they're not, bankruptcy, while messy, is the normal and natural way that you solve issues of inefficiency and overcapacity. It's also the way that you solve the problem of excessive general and administrative cost across an industry. One of the things that a bankruptcy does, and consolidation does, is it eliminates the management teams, or at least it should eliminate the management teams that were responsible, at least partly, for the company to become a bankrupt entity.
Rick, I want to ask you if this might be difficult to answer, but let me know if you've seen this, because this is a business where one large discovery can hide a lot of sins. And I'm wondering, when you talk about the industry being overcapitalized, essentially what's happening is less capable teams are being supported here. But there is an aspect of luck as well. As much as people in research and development don't like to admit it, there's always an element of luck in this. So I'm wondering if you've seen instances where maybe this overcapitalization has paid off in the sense that great results have come from unexpected places.
It has certainly paid off in an individual sense, but I would argue that statistically it's extraordinarily inefficient. I'm sure that you noticed, Albert, when you were an engineer, that luck seemed to concentrate around smarter, harder working people. And that happens in the minerals business too. If you assume that there are 50 or 100 economic mineral discoveries that take place in the course of a year, which is to say 500 or 1,000 over the course of a decade, what happens is that they're not distributed across the whole population of earth scientists, but rather they concentrate. So you have a David Lowell as an example. And I point him out not because he's made these discoveries, but he's headed teams that have made discoveries, 12 or 13 economic mineral deposits over 40 years. You look at the exploration success enjoyed by teams funded and headed by Robert Friedland. The truth is that some people are better at certain things than other people. And while it's certainly true that if capital were less available, there would be less discoveries in the aggregate, the amount of capital required to make a discovery, I suspect, would go down a lot.
Rick, years ago, when around the time that we met, I think it was a good time, this optionality theme. It was a good time to be invested in companies like that. With this crazy volatility we're seeing now, has that time returned?
I think actually, Albert, it has. The difficulty between now and then was that the optionality theme hadn't played out. And you could buy large deposits very cheaply because there was no appreciation in the market that when the gold price went up, the amount of money that the market would pay for the deposit would go up exponentially. The problem with optionality now is that it's a theme that has been proven, so it's very difficult to find a way to do it cheaply. The second problem with the theme is that optionality, ironically, requires management teams to do nothing. If you have a gold deposit, let's say a large gold deposit, a 5 million ounce deposit that doesn't make much money at $1,500 gold, but would make a lot of money at $2,000 gold, the right thing to do is buy it and then do nothing. Management teams don't like to do nothing, and investors are impatient. And management teams in particular don't like to be paid appropriately for doing nothing. So the twin problems of optionality speculation as we speak now is that the theme around optionality is popular enough that companies like Seabridge, as an example, which in the first go round had a $50 million market cap, now have a $1 billion market cap. In other words, the price, the cover charge that one pays to enjoy optionality has gone up substantially. The second problem is that companies that have assets that would benefit from optionality often have such high general and administrative expense that they need to keep issuing equity to pay the general and administrative bill, which lowers the optionality on a per share basis that shareholders enjoy. So yes, it's a great theme, but you have to be much more intelligent employing it than you used to be.
All right, Rick, we're going to leave it here for now, but I just want to let viewers who have been enjoying these interviews to visit us frequently, especially next week, as Rick and I are going to be doing deep dives into all of the precious metals and commodity investments that he covers. Thank you, Rick, very much for joining me again, and I can't wait to get at it next week.
Always a pleasure, Albert. I look forward to having these discussions with you.